The trickle of global reaction is turning it to a torrent activity as the central bankers and central bank leaders in Europe and Asia comment on the Fed's continued hawkishness. The ECB watching key economic data ahead of its call next month, while Japan is set to maintain its dovish outlook. So let's take a look at global markets with Jennifer Lee, BMO Capital Markets senior economist and managing director. Jennifer, great to have you here with us this morning. First and foremost, as we think about the international calculus that's taking place right now, we've already seen some of the indication for at least economists here in the U.S. to believe that the recession fears are actually more pronounced in Europe and in Asia as well than they are here in the U.S. What's your take on things right now?
Well, good morning, and thanks for having me on. You know what, I'm going to tend to agree with that. I think, we do not have an actual NBE or defined recession baked into the U.S. Or for Canada, for that matter. We do have a quarter of negative growth early in next year, just in reaction to all the aggressive Fed tightening that we're seeing. But I think Europe is just playing with it's a whole different level of things going on over there, and clearly it's a little bit of a mess, to say the least. And, it's basically the energy story that continues to throw the economies into turmoil because it accounts for such a large part of their inflation reports. And then, of course, with inflation continuing to hit record highs, and we're probably going to see another record high reading for the euro area. August reading this week, we're probably going to see more aggressive tightening from those central banks, namely the ECB and as well the Bank of England.
And Jennifer, yeah, you're right. It's certainly been a mess, and it's been a mess in equity markets since Friday, and some of that mess is carrying on into today. We're getting a lot of different reads on when Jerome Powell said pain. We're getting a lot of different interpretations of that. How much pain do you think will be coming to the labor market as a result of what the Fed is doing on rates?
I'm going to say that there would be a little bit more pain to come, but at the same time, he's already said on multiple occasions that the labor market is tight. And I don't think anyone's going to disagree with that, especially with the number of job vacancies still way over the 10 million mark, way exceeding the number of unemployed Americans. So I think he is willing to inflict more pain on the labor market and on the U.S. economy in order to achieve what they want to do, which is to bring inflation back down to the 2% target. How long that's going to take, as anyone's guess, we don't think that's going to happen until probably 2024. It's not going to happen next year, or definitely not this year as well. But they're willing to do more, obviously, to fulfill their mandate of price stability.
With that in mind, do you believe that we're set up for a 75 basis point hike at this upcoming meeting?
Oh, that has been a great source of debate within this group already this morning. So far, we are looking for we're baking in a 50 basis point hike in each of the next two meetings, and then following up with a 25 basis point hike at the end of the year. Everything is data dependent, so we're very flexible in what we're looking for. So if we continue to see strong labor market gains for this Friday's report, looking at what average hourly earnings are doing, and definitely what's going to happen for the next CPI report will probably determine, whether or not it's going to be a 50 or 75 basis point hike. But 50 basis points is still a lot. It's not 75, but still 50 beeps is still quite a bit, and that is going to be part of that whole pain inflicting onto the American consumer.
Given this series, Jennifer, of really aggressive rate hikes from the Fed, and they're going to, by all indications, they're going to continue. What does that mean for the inflation that households have been dealing with for the past year? Should we expect major declines, or is it more drip-drab declines?
I think it's good. That's a great question. I think we're going to see inflation continuing to head a little bit lower, because at some point, all of these rate hikes are going to have that impact of dampening price gains. But we're not going back to 2%. Tomorrow, it's going to stay elevated for some time, which is why we're not going to see rate cuts for probably not until 2024.
All right, we'll leave it there. Jennifer Lee, BMO Capital Markets senior economist and managing director. Good to see you. Have a great rest of the week.